Hello and welcome to SumZero Headlines. This is Avery Pagan. By now, you've been inundated with stories on GameStop. What happened during those fateful weeks in late January, what sent the stock price swinging to record highs, and the influence of retail investors. We're here to bring you the story you haven't heard, the fundamental picture of a business that has been actively reinventing itself and its relationship to the consumer for years now, in a conversation with an investor who's been involved in GameStop for over a decade. Scott Preston, the founder of Maven Group, a San Francisco-based long-short equity fund, has been a member of our Cap Intro program since 2018. And today he offers his perspective on GameStop. By his account, they are a growth-minded business with numerous shots on goal to expand into social gaming, esports, e-commerce, and direct-to-consumer advertising. Put aside what you've heard about Reddit and short squeezes and tune into this episode with Scott Preston for a different angle on the GameStop saga.
Well, welcome to the SumZero podcast, Scott. It's great to have you. Just, I guess, by way of introduction, GameStop has obviously been the topic du jour in the financial markets for most of 2021 so far, obviously dominating headlines throughout January and even in February. And I think, for the SumZero community and also investors kind of more broadly, we've sort of been seeing a lot of headlines around everything from unusual options activity on the name to discussions around, the entire financial system being rigged, discussions around payment for order flow. And then obviously there was that fairly unusual hearing in front of the House a few weeks ago featuring, on the one hand, Ken Griffin, head of Citadel Securities, to head of Robinhood, to the Reddit trader who, started pushing GameStop as a long, just on social media. But I think the story that maybe has gotten lost has been the fundamental one, which is, what does GameStop do as a business? What does their future look like as a business? Where are their growth opportunities for the business? And what's it actually worth on an intrinsic level? You have obviously been very bullish on GameStop for quite some time. And actually, we've had folks on SumZero, even as of 8 years ago, talking about GameStop as a potential long, with lots of upside and sort of being this almost forgotten name because of its retail oriented business. But you in January of 2020, about a year in advance of all this drama around the name more recently, had pitched GameStop as a long back when it was trading under $4 a share. And your thesis had nothing to do with short squeezes or some of the stuff that we've seen in the media recently, but really had to do with the fundamentals of the business. And so could you just, again, just to introduce yourself, could you tell, just kind of our audience about kind of your own professional background and this sort of work that you do at your current fund?
Well, Didi, thank you for having me on the podcast. I'm very happy to be here to discuss Maven and our involvement in the GameStop story. I started Maven Fund in 2007. I've been in the investment business since 1997. So started the fund about 20 years in. And Maven's background has been a long-short hedge fund, primarily focused on long, deep value ideas that are mostly misunderstood by the market, and that I think have a lot of asymmetry and upside to them. So that's kind of been our focus. GameStop, which we can get into later, fit perfectly kind of into that asymmetry back about a year ago.
Yeah, so maybe on that note, can you just walk us through what or how GameStop hit your radar? What were you screening for, if you remember back, like a year ago or even in 2019? Like when did GameStop first hit your radar?
So GameStop's actually been a name I've followed for quite a long time. I'd actually been involved in the stock from around 2010 to I think 2012, and playing the last console cycle. The bull and bear thesis were kind of similar then, with some different dynamics, but the bear argument was definitely the same then. I exited the story when they kind of diversified into some other businesses that I didn't find particularly attractive. And so I kind of had kept the name on my radar screen, and then I knew this console cycle was coming. I'd kind of been from peripheral watching what the new management team was doing as far as realigning the current business and setting goals for the new business as they enter this console cycle. And so with the stock at between $3 and let's say $6, and a decent balance sheet at that time, and at that point we had already known that the new consoles were going to have both discs and were going to be backward compatible, something that I felt was going to be particularly attractive for the consumer. And I knew that the console cycle couldn't save GameStop, but I thought it would give them a unique opportunity to re-engage with the consumer. And I felt that upside was maybe 50-50 or something, but that the downside was so limited given where the stock was trading that if I was wrong, maybe I'd lose 5-10% or something. If I was right, the upside could be pretty enormous.
And on the downside, I mean, it sounds like, are you speaking to kind of the balance sheet strength of the business, or what made you feel comfortable about the downside?
Yeah, so I with the stock at $5, management had just completed a pretty aggressive buyback program. They had bought back between, I think, 35 and 40% of the stock, around $5. That left them, they had about $400 million in debt and about an equal amount in cash, I believe, at that time. And the business they were showing operating losses, but it wasn't burning cash. And a lot of that was coming from the new management, and particularly Jim Bell, the CFO, really focusing on working capital and driving inventory turns. And so I felt they had plenty of run room to get to the new console cycle.
Right.
And at that point, we would see some cash flow generation, and we can get a little bit more deeper in the story. And so that's kind of, to me, I knew they were going to have a window of time of excessive cash generation, and how they use that was going to be important. But that kind of provided the shots on goal.
And then one of the things that you mentioned in your SumZero piece, and actually even just now, is that you weren't solely relying on the new console cycle picking up and providing a tailwind for GameStop, but there was a lot kind of that had to do with them rethinking kind of their customer experience and just sort of how their stores operate. Do you want to maybe get into some detail on, like what they envision the GameStop experience to be, and how that would drive growth? Yeah,
and I'll speak in terms of when I came to the story. Some things have changed a little bit now, but yeah, at that time they knew what the new management team realized, and the company, since Paul Raines had passed away a couple of years ago, the company had gone through several different management teams. With this management team in there, what they really did that was different was embrace gaming. And this is a large market; it's growing rapidly. And what I saw was, I really liked that re-engagement, and there was a lot of ways to win. And they were realigning the business, shrinking the store count, and trying to really figure out the best way to re-engage with their customers. And so the console cycle for me wasn't like it was going to make or break the company, but what it provided was a period of time. 18 months was kind of what I had in mind at that time, to re-engage with the customer. The customer was going to come to GameStop for consoles, and that was their opportunity. They have this large Power Up Rewards program to re-engage, and that could be through esports, social gaming. There was just so many shots on goal to really re-engage that customer base. And since then, there's been a couple attractive opportunities that have come up as well that we can get into a little bit later. But at the time, that's what I really saw. And if they got one of these things right, it could transform the business. And then you would still have the legacy business that would, do what it was going to do. And you would see kind of a steady decline in the physical gaming business, but there'd always be a spot for that, but that wasn't going to be the story. Kind of like how Netflix today still has I think it's $60 million a quarter DVD by mail business. So kind of that was my initial thought process going into the trade.
So what would be the upsell? I'm just trying to understand this from the standpoint of the consumer. If I walk into a GameStop today, or maybe the GameStop of tomorrow, GameStop 2.0, or however you want to call it, what am I, what is the upsell? Like beyond buying a physical game for nostalgic reasons, like how is GameStop going to monetize that new customer today when they do go into one of their 5,000 stores?
Yeah, so I think that's still we're going to hear a lot more from Ryan Cohen on that. So stay tuned. But I think what management had done up until now is, they had so many stores that some were across the street from each other, and they had gotten dated and old. And so what they were trying to do, cluttered with inventory, is really streamline the experience and the process. And their Power Up Rewards program is pretty interesting. And what had happened to GameStop throughout their kind of diversification out of gaming and into these other segments is they kind of forgot about their customer. And now they've re-engaged back with the customer. What does the customer want? Do they want it digital? We can help, sell them digital. Do they want accessories, right? You can't deliver a controller digitally, right? You have to go to a store, or you can order it online. They had no e-commerce presence. They built a $2 billion e-commerce business in a year. So how does the consumer want it? Receive their games? Do they want physical? Do they want digital? And how do they want to kind of consume this experience? And that's what I think what they were pushing towards. I think Ryan Cohen came along and wanted to accelerate that. But really, I think they had lost so much share over the years, and it wasn't just digital. It was to Amazon, it was to Walmart, and they just kind of lost that engagement with the customers. So if you look at their rewards program, it's pretty powerful, and the amount of value that it can add to a member in just a short period of time is tenfold the cost to join it. And I think it's re-engaging with that customer, getting them into those plans, and then you almost kind of lock them in. It's just people order stuff on Amazon because they have Prime, and just in their mind, I have free shipping. I just do go to Amazon. It's the first place they go.
Right.
And so I think GameStop's trying to really re-engage with the customer. What do you want? How do you want it? What's the least amount of friction? We'll give it to you, and we'll figure out how. And so that's kind of how they've really tried to re-engage the customer. And then there's new lines of business. They're looking at things like operating esports leagues for high schoolers, and there was a lot of the things that they were working on kind of got sidelined by COVID. Try before you buy in store and various things like that. So those are kind of some of the new things. And I think what Ryan Cohen's brought to the table and what he saw is a consumer that is probably more fanatical than any other segment. If you look at
let's take a step back actually, because I think the Ryan Cohen sort of fact pattern is incredibly interesting, and for whatever reason completely untold. I don't think many people in mainstream media have really talked about Ryan Cohen. Do you want to just give the audience just a background on him, why he's important to the story, and a little bit more on his own track record? Because I think it's pretty incredible what that guy's done, with his first business and now with GameStop.
Yeah, of course. So Ryan Cohen was the founder of Chewy, which was sold to PetSmart and then respun off to an IPO, and it is now a public company. I think it's a $45 billion company that sells pet goods online. And so he was founder of that at a very young age, sold it, I believe made it several $billion, and has kind of took a step back from business and was kind of an investor for a little bit, and then hadn't done much, and then took a small stake in GameStop, I believe. Actually, his first investment was in actually mid-19, I believe, and it started engaging management then. He filed as a 5% plus holder, I think it was in August of 2020.
Yeah, and I think the key point with him is that unlike a lot of financial investors, he was a successful operator at a very young age. But then after that, I was reading on Wikipedia, he was apparently the single largest individual shareholder of Apple. So it looks like he took a significant portion of his Chewy proceeds and put it in Apple stock, which I'm sure he made a ton of money on, and has become essentially an activist at GameStop. But I think that the interesting thing about him is just how successful he's been as an operator. So he's sort of seen these businesses from a more sort of from the ground, as opposed to just looking at financials and 10Ks and 10Qs. And I think that probably lends him a little bit more strategic insight into turnarounds and how to reform and transform the brand, and how people think about GameStop as a business. The Melvin Capital way of thinking about this is that, okay, it's a melting ice cube, and this guy clearly sees a different narrative altogether, as do you, and I just think that's a really interesting thing coming from a guy of his background.
Yeah, exactly. And I think he saw the same thing. People are very fanatical about their pets. They don't hesitate to spend money on their pets. And there's a similar aspects of gaming. I mean, there's very few things that, I can put in front of my children that will keep their attention for 10 hours. And video games will be one of those. And it's, they have an incredible focus when it comes to that. So I think he saw that. He saw a massive market that's growing. He saw a business that kind of had its hands deep into it and just maybe needed a little bit more vision. And I think something that's incredibly important about Ryan Cohen is, and you've seen Jim Cramer, the latest on TV, is people, when GameStop really first took off, the stock price, people were like, oh, it's a bankrupt retailer, therefore it's this big joke. And now you're starting to see, to me, a little bit of change. And I'm not arguing the stock's a buy here or not. But, even this morning he said, we got to wait and see what Ryan Cohen's plans. And the difference with Ryan Cohen is investors will underwrite a business plan from Ryan Cohen like they wouldn't with George Sherman, the current CEO. And so I think people will give him the benefit of the doubt, and potentially, it's a self-fulfilling prophecy, right? Oh, Ryan Cohen believes in, therefore it's going to work, and that in itself can, help the company and further help the stock, so it can kind of feed off each other.
Absolutely. I mean, I think to the extent people buy into his plans, the share price will reflect that, and that should give them even more runway to recapitalize the business and really plan for the long term, which is great. So from just from a valuation standpoint, obviously the stock is no longer at $3, and it's I'm looking at it right now. It's got an $8.25 billion market cap. How do you think about this? Maybe from a range standpoint. What would you expect to happen from a top line standpoint over the next 5 years? I think was there 2020 sales around $1 billion? So what's their sort of?
I think the consensus is about $5.5 billion. Their fiscal year is a little off, but we'll just say calendar 20 and 21, about $5.5 billion, and then $5.6 billion next year in sales. So right now, for fair disclosure, I'm currently long some stock, but fully hedged on it.
Sure.
I had sold most of my GameStop on the way up. However, partly because I felt that the stock would pull back and needed to find a level and where things were just calmed down. But so I think thinking about valuation here is pretty interesting. So company's got an $8 billion market cap, slightly over that. I think they can do about $7 billion in sales in fiscal really 22. It's kind of calendar 21, ends next January. So maybe a little over one-time sales. When we look across, technology companies or even outside of technology, S&P 500, that's not expensive. Now, they've got to prove that they've got a sustainable business. But if they can prove they've got a sustainable business with any sort of growth, the stock, the valuation is not all that demanding here. And I think with some of the new opportunities, I think will become more appreciated with the stock will be some of the more kind of, to me, user-generated business opportunities that they're able to articulate to Wall Street over the coming months. I think the company is likely to launch a targeted advertising platform for publishers and the console makers to really go after the hardcore gamer in a more direct fashion. There's really nothing like that. And they know everything about these consumers the last decade, what games they've bought, what their age group is, demographic, all those different kinds of things that are valuable to Electronic Arts. And I think what the bears kind of missed in an opportunity like this is that, yes, things have gone digital, but the customer acquisition cost for a gamer has not gone down. And these big games, whether it's Grand Theft Auto, there'll be $300 million of marketing spent on one game. And it's just a little bit haphazard. So if you can go direct to that consumer, there's incredible value there, because getting these consumers on your game is different than in the past because of the residual value. The in-game purchases can have a very long tail to them and be very valuable to these publishers. So is there an opportunity for GameStop to go after that $35 billion marketing opportunity? I think there is. And if they get 10% of that, that's a very different business proposition than people thinking about.
Yeah, I mean, what you're describing almost sounds like a Facebook within gaming of sorts.
That's right. That's absolutely right. And I think they'll be able to articulate on that potentially in the months ahead. So that's just one thing that they have an opportunity to go after. And so when you start adding up the shots on goal, you see why someone like a Ryan Cohen acquired, I think he's about up to 17%, I want to say, of the stock, because he sees the shots on goal and the opportunity to go after that quite quickly. And I'll tell you that with the stock doing what it's done, a lot more people know about GameStop today than they did 2 months ago, 3 months ago. And the amount of free advertising they've gotten, I don't even know what that would cost them, billions of dollars. So
right. I was going to mention that the earned media that they've gotten for free it's really incredible. And actually, I think what's awesome for them is that because they have a reputation of, and this is obviously something they're trying to change, is being, a physical retailer. There are a lot of folks who are rooting for them with this backdrop of COVID and forced shutdowns, where, I think people, consumers and even investors alike are rooting for, that brick and mortar business to kind of come back, especially with vaccines rolling out and all this stuff. So I think all that bodes well for them. And it ultimately, I think in the long run, it'll come down to execution and some of the stuff we've talked about, and the growth plans and all that. But there's no question that all this, all the people talking about it is going to help them, even if many of them or most of them don't know what they're talking about.
That's right.
Yeah. Well, listen, Scott, I don't know if there's anything else you want to add.
Yeah, I would just say, I think, for people looking at the stock now, I think, obviously it's kind of taken on a life of its own, but I would suggest, potentially keeping their eye on what Ryan Cohen and the company have to say. I think they're going to be reporting earnings mid-March. We'll have a better opportunity on some of these new shots on goal, and I think from there people can kind of start to look at underwriting a different type of investment.
Right, and actually I forgot to mention, but obviously there's been a lot of regulation talk about social media vis-a-vis GameStop and other meme stocks. You probably saw some of the testimony in the House. Is any of that relevant to your thesis on the business itself?
No, I think a lot of that stuff was in the news. There was you had hedge funds failing or on the verge of failing, and I think people wanted answers to kind of how this could happen. And at the end of the day, this short squeeze they happen all the time, yearly, every decade. They've happened for 150 years, and I think that's why that story's kind of gone away. I think talking about maybe the size of the short position in the stock and how many options contributed, those are kind of some other things, but some other dynamics, structural dynamics. But that would be my only comment there.
You don't expect any sort of regulations that would curtail shorting itself?
No, I don't think so. I don't think so.
Yeah, I mean, that was some of the more extreme commentary. I mean, like, again, I'm watching the same news and the same media that I think everyone else is, and that was some of the more I think draconian reaction to this whole episode was, we should ban shorting, which I mean, I think that's extremely unlikely to happen. But it's funny when something like this happens, you do get headlines that are pretty provocative, and that was something that I saw. The stuff around, I mean, I guess there were also talks around settlement periods and pay for order flow. I suspect none of that really has any real impact on GameStop. Would you agree?
Yeah, I would agree with that. I mean, those are, people just need to remember, nothing's actually free.
Right.
These are for-profit businesses, and so they're making money off you somehow. But yeah, I think shorts provide a good regulator on the market. I think they provide, liquidity. I think they keep people honest. I think there's a great place for it, but it can be dangerous at times, because if you buy a $10 stock, you can only lose $10. If you short a $10 stock, you can lose 500. So,
Right. I think it's funny you mentioned that, and I think to a lot of people who maybe have never shorted it, that may be news. But it's interesting that some of these hedge funds were so aggressively short this name, and experienced some of that volatility head on. Well, Scott, listen, this is great. I think you framed this well. I hope that people think of GameStop more as a business and less as just purely a trading vehicle, which for good or bad is sort of how it's been treated over the last month or so. But I think it's enlightening to kind of hear what their actual business plans are and what they, how they plan on competing in this market and transitioning out of just being, a traditional old school brick and mortar retailer. So thanks again. And hopefully we can chat again sometime, as maybe over the next short squeeze.
All right. Well, thank you for having me.
That is all we have for you today. Thanks for listening. You can read Scott's original research on GameStop on SumZero, or learn about Maven Group's active strategy on our Cap Intro platform. If you'd like a direct introduction to Scott, please reach out to the SumZero team. Otherwise, happy hunting, and we'll see you next time.